Rolling.
What's up, everyone? It's another edition of Saturday Talks now. So today we have two guests. One is Chandrashekar talking about valuation of companies. From a stock market. Assets. My bad. I don't know shit about it clearly. So yeah. So that we can all start playing the stock market, hopefully. Yes. Can we take away at the end of this talk on how we can like play with the stock market? He said yes. So right after this we will have we'll also have one more talk. He's not here yet. You know what? I'll do another intro for him. So without further ado, Chandra, everyone. Thank you.
So when I'm talking about valuation, like we usually value things in the form of we come across commodities which we buy. Like if we have some dal as a commodity, we see like whether we can buy that or we cannot buy, like what quantity we need to buy. So dal is generally we treat it as a commodity. Whereas there are things which we treat them as an assets, like rather than commodities. So when we have commodities, the price is determined by the market itself. So you know that as the price increases, quantity demanded decreases. So if this is a commodity, as the price increases, quantity demanded decreases. As the price increases, quantity, this is law of demand basically. So the market decides the prices of commodities, and we don't have like much say in general. Like, we usually go there and we pay the price and we take. So while coming to assets, so asset is something
in this law. I'm sorry. In this law, can I ask questions in between? Yeah. In this law of demand, there are two variables: price and
quantity.
demand. Price and quantity.
Yeah. Quantity demanded.
Quantity demand. So one should be dependent and one should be independent. So there should be one thing which is independent of the other. Like price. Doesn't depend on
it's not
demand
a
as well.
definite law, right? Usually if the price increases, quantity demanded decreases. It's not a definite law, but it usually follows that kind of.
Now sometimes it happens that when the demand of a particular commodity increases, its price also increases.
Increases.
Yeah.
Demand increases. Yeah, demand. No, I'm not talking about demand. Quantity demanded. If you fix the supply and if you increase the demand, that's a different case. I'm talking about price and quantity. People usually know. Okay? If you're talking about so if you take an asset, we don't really buy it with an intention of like just consuming it. So while in the case of an asset, we buy it because we feel that at a later point of time, it gives us like a better value than what we have purchased it now. That is the purpose of buying an asset.
Let's say you buy some house or something.
Asset can be a commodity to some extent.
But not considering that you will be getting
No,
higher price.
it depends on your intention, right? You are buying a house to stay, and you plan to stay throughout it and never plan to sell it. Then it's a commodity for you. But you have like partly you want to use it and partly you want to sell it as an asset. So it's partly commodity if you are trading as a house. So the asset is basically something we buy at a certain price, and in future we expect that it generates more value for us than the present value what we have invested.
Car will be an asset or not? Because right now I'm going to use it, but I'm going to sell it in a lower price.
If you are owning a car, it means you are owning an asset. But
I'm not going to like sell it in more value.
no, like usually your intention to buy an asset is to you're intending to sell it at a higher price. So if you are owning a car, you can treat it an asset that you have like some amount of cash.
But these are unusual cases.
No.
This is not, I'm not going to sell it at a higher price.
So basically, I'm talking about investing in an asset. So you can treat anything which gives you some value as an asset, but the purpose of you investing in an asset is you expect a higher value in future. Like you don't invest in a car and you put it aside, right? But you might invest in a real estate or a land and you.
My question is, car will be like considered as an asset or not?
Yeah, it's an asset.
Chandra, since we have Rajat in the room, you can expect questions every 2 minutes or something. So if you want, you can like stop all questions
Yeah.
at the end of the.
Yes.
Let's keep it as a TED talk. No, I mean, like, let's note our questions
Okay, yeah.
and ask them in the end.
Yeah.
Like if that functions, the TED talk can happen. Let's all follow that thing.
So how are these asset prices determined? Like when we talked about commodities, we talked about the like demand supply. It has its own intricacies how it determines the price. But usually, like sellers try to maximize their profits, and we usually reach at a balance between our demand and their supply. So when it comes to commodity, like lot of other things come into play. So when we are talking about buying an asset and we are expecting a future expectation, it is possible that the asset value can be keeping on increasing. So, and more and more people coming, and more people giving more and more money for that asset. Because there is something called, like, there is something not very definite, that if you take a general commodity, as the price increases, the demand decreases. But in the case of some kinds of assets, as the price increases, people think, oh, it's a really good asset. People feel that it's a really good asset. And sometimes the demand also increases. So that leads to the creation of the so-called financial bubbles and all. So the point of valuation is, assets can be assigned a fundamental value. Like, even though the value of an asset is in the perception of people, we can assign a fundamental value to an asset. So if you go to a real estate broker and you want to buy a land, so the broker will tell you like certain price. So how is this price usually decided? He'll see a similar asset which is selling in the nearby locality, comparing the like how old it is. So he'll prescribe a thing. So if suppose a new buyer comes and bids a higher price, automatically the price of the asset increases, and along with it, the price of all the nearby assets may also increase, depending on the perception of people. People think, oh, it's a very growing market, so I can buy more and more things here. So the asset price can also increase based on that. So, but when you are finding the fundamental value, it doesn't mean that the asset is being transacted or sold at that price. We are not we are not trying to find that basically. Fundamental value is something that with that asset, the amount of value which can actually be created. Like if I have a real estate thing, some land, I cannot create, if it's being sold for 1 crore, I should be expecting that 1 crore for me, that it will create more than that, it will create for me. But if that's not the case, there is no point of paying it 1 crore. So the fundamental value of an asset is basically the intrinsic value, the value present in the asset. So by holding it, or somehow you can sell it, somehow we can create the value that more than the value invested. So why fundamental value is important? Because even though the assets don't transact with their fundamental value, why do we need the fundamental value? Why do we need to do valuation? Valuation we need to do because if you take an art like some painting, sculpture or something, so we can expect that the perception of people remains the same. If you treat it like, for example, you take Mona Lisa. We know that people keep on admiring painting, and the value of Mona Lisa will stay substantial. There is no doubt about it. But the case of the general other assets which we see, so if some house is translating 10 times its fundamental value, and you purchased it, so when the perception of people might change. Like suddenly people might read, oh, this area is not a good performing area, or sometimes people start selling at a lower price because no one is buying it. So the perceptions will change. So these perceptions will change, and the asset can be transacted. Like you might be paying lot more amount than the amount which you will be able to procure in future. So the basis of fundamental value is the amount of value that can be generated from the tested, with like disregarding the perception of people.
It's at current time.
Yeah, at present.
At present.
Can you give an example of fundamental value for, say, a house or something? I'm not a good answer.
Yeah, I'll come back. So the purpose of this all is the how we calculate the fundamental value. Valuation is the how we calculate the fundamental
It
value.
is the same thing like if you are mortgaging a property to the bank.
Hmm.
So it will, the property you are mortgaging, the bank will value it on
Not according to fundamental value. It
it will
will
according to fundamental.
not. It will value according to the government.
Circle rates.
Yeah.
I thought they were saying.
No. That's why banks create all these bad assets, right? Because they lend money assuming that this asset is very high, and suddenly the asset falls. So that's why.
But government valuation always tend to be on the lower side.
Lower side, generally.
Yeah.
Lower side.
Generally on those.
So the risk will be lesser, right?
Yeah, less. Not all cases. Some cases it will be equal. Like, I hope you have got a clear idea, like why there is a necessity of finding the fundamental value, even though you are not actually buying things at their fundamental value. Okay. So now, how we'll find the fundamental value of certain thing. For an example, I take a chicken, a hen. So the hen lays an golden egg every year. Okay. So each year, at the beginning of the year, it gives you a golden egg. So not necessarily like not golden egg. Like assume like 100 rupees valued egg. Any egg which is valued 100 rupees. Okay. So whenever you each time at the beginning of the year, you sell the egg at 100 rupees whenever the hen is. So how do I value this chicken at this point of time? So on my first year,
You will use that when I think
right, so So, by the way, there are many mathematical models to value assets based on the money they generate or the value they create. But all the models will come up to the ultimately to the value creation only. So, like when you're talking about stocks, they talk about dividends. When you're talking about real estate, they talk about rents. But ultimately, everything comes up to the value creation only. So, what like I'm getting paid 100 rupees at the beginning of the year, every year. So how do I value this chicken?
Life expectancy.
So basically the value.
Life expectancy into 100 by definition.
For now, let's assume that
Calculate to
it's return. Like you get every.
But due to inflation, the value will come decrease and decrease, so it will come to zero.
So every first year I get a egg value at 100 rupees. So basically, when I'm trying to find the fundamental value of this, I'm trying to say what amount I can pay to buy this chicken, which lays 100 egg value at 100 rupees every. So suppose if I bought this egg at like maybe it lays like in 10 years, if I see it lays like 1000 eggs. Sorry, 10x, which is valued at 1000 rupees. So can I buy it at 1000 rupees is my question. But the thing comes up here is the 100 rupees which I get in the next year is not same as 100 rupees me getting now. Because so many things come up. There is something called discount, which discount rate. Like rate is discount, which is the present value of the future money which you are getting. So the rate at which the money is being, the value is being discounted is called discounted rate. So if suppose
That's because of the inflation, right?
inflation, the effort you put and you have some expectations over your returns. Like instead of instead of buying this, I could have invested in a bank account. So at that point I would get like 6-7% interest rate. So that's also comes into play. So usually this discount rate, if you calculate it, if you want an return equivalent to the bank interest from the investment, you put a discount rate equal to bank interest. Okay. So, but again, I'm doing like bank, putting in bank is very safe thing. Like, but here we are doing putting like some more effort. Like we are maintaining the chicken and all. So we might expect a little more discount rate. So on the first year, I get 100 rupees from the chicken. On the second year, let the discount rate be D. So the present value of the future asset will be 100 divided by 1 plus D. So the value of it depreciates. If I considering the present value of it, I will discount it by 1 plus D.
So why 1 plus? I didn't get it. Is there a long explanation? You can check it.
It's not a long explanation. Like if you calculate mathematically, that's what you get. So, like if you invest 90 rupees now, it will be 100 rupees at that time. Suppose.
Yeah.
So 100 rupees at that time is equal to 90 rupees. Okay.
Maybe
So,
some
yeah. Okay. If 100 is there,
No, take it.
I'll multiply with
Example D, no? Discount rate is 1 plus.
yeah. Suppose 15% is the discount rate. Okay. Suppose 10% is the interest rate,
Bank interest.
bank interest rate. So 100 rupees for me now will be equal to 100 into 1 plus interest rate, isn't it? In the future. Okay. So 100 rupees in future will be 100 by 1 plus interest rates now. Okay. So basically, it need not. So that's what I'm saying. Like the discount rate need not be equal to interest rate, because since you are doing some business, you expect a better return when compared to the. So you decide the interest rate based on the expected returns which you want. So suppose I expect something equal to 10% returns from this. It will be 100 by 1 plus D, which is 0.1. On the third year, say the value of this will be the 100 rupees divided by this corresponding. The value of this money will be divided by 1 plus.
Keep on getting squared.
Yeah. So it's a infinite series, and you will get a value. You can calculate the approximate value of that product at current price terms. So this will be
The sum of the series will give you the current value.
yeah, current one.
So it's like what you're trying to say is when I calculated for 10 years, it came out to be $1,000.
Yeah.
But me paying $1,000 doesn't make sense.
Yeah.
I should be paying something lesser than 1,000 rupees today. Is that
Like
1,000
the present value of that 1,000 rupees which you are going
is
to
lesser?
Yeah.
The 1,000 rupees which I acquire eventually in the future would have more. So I should not be paying 1,000 rupees.
1,000 rupees. Yeah.
Lesser than
You
that.
should discount it according to the present value of that 1,000
Oh.
or 1,000 rupees.
And then you have to make the profit.
So, but again, like if there is risk involved, like the chicken might die and all. So if suppose the lifetime is only 10 years, I add up to 10 years and I get the present value of the total cash I can generate to the chicken with respect to the current value is the amount fundamental value of the chicken that I can pay.
But do we pay that fundamental value or not? Like right now, if I pay
No,
that,
it makes sense for you to pay fundamental value. Like,
but I won't be getting any profit, right? I just paid what I will get in 10 years.
no, you are assuming in profit in.
You are assuming
Discount.
profit in discount rate.
So, like you take the minimum discount rate which you can, which is suitable for you, and the whatever is left is the profit mechanism. So, but if the best way for you is to buy it below the fundamental value. If you are buying above the fundamental value, it doesn't like it's a bad bet for you. So, but most of the assets do not have like fixed rate of returns. So there is a thing that if an asset, the returns from an asset grows at a continuous 8 to 10%, like with respect to inflation, returns from an asset, the value of the asset is like infinite. If an asset can generate me a returns of 8 to 10% through over my investment value, the value of an asset will be, which means that such kind of assets don't exist. So in assets there is like the law of diminishing returns. That
But you can have companies that do this. You can have companies, right?
Companies also cannot grow at that rate. Eventually
Eventually stop. Okay.
like right now they might have been growing for 100 years,
Okay.
but we can be sure that they won't grow for like, 20 years at above 8% with respect to inflation. So, but again, all assets don't give like fixed returns and all. They have like so many things involved. So if I am talking about a real estate asset, usually if I am like, I'll give you a rough calculation of how I can value a real estate asset. Suppose 10,000 is the interest I am getting every month. Okay? So, and if I consider the discount rate as 10%,
Rent you.
10,000 is the rent. So I invested in a real estate asset and it's paying me rent. 10,000 is the return I get every month, like throughout in the future also. So it's not increasing. So the return will be 10,000 using the infinite formula. It will be 1 minus 1.1. 1.1 minus 1 is
1 by 1 1 minus 1 by 1.
1 by 1.1, yeah.
So this will be around like 11 times of it, I guess. 11 times of the whole thing is
Almost.
roughly. Yeah. So, this is per month, so into 12.
Okay, I didn't get that.
This is per month amount.
What's in the denominator?
That's 1 minus 1.
That infinite series with
The sum of G infinite G is AF1 1 minus R.
1 minus R. Okay. So that will come up to 11 times roughly. I'm not getting. So it will be 1.2 lakhs into some 14-15 lakhs. So if you take a real estate asset and if it's paying me a rent of 10,000 continuously, the amount I can pay is just 13-14 lakhs, which is not the case which we find in the market. Why is it so? The thing is because
Just a second.
Price
So
increases.
you're saying 13-14 lakhs is the total amount I can get back from it forever.
forever.
Even
if it gives me a rent of 10,000
forever.
because if that is the case, you can pay only like 14-15 lakhs to it to buy it.
Okay, to buy it.
And in this calculation, you have assumed that the value of 10,000 rupees remains constant for an year at least.
14.
Suppose you multiply it by 12.
Yeah.
That
And
year
also
also.
Every beginning of the month,
For a year.
So again, the 10,000 is not constant. The rent is not constant. It keeps on increasing like around 5%. So when you take the 5%, you arrive at the fundamental value of the 5% inflation. If you are considering that inflation is continuous at 5%, inflation of that asset is 5%, fundamental value of that, you can calculate. So again, if you are planning to sell the asset at 10 years later, the minimum value which makes sense to sell it can also be calculated using the same formula. So up to 10 years, how much returns you got, the present value of that money always, the present value of the value that has been created, that is going to be created in the future, plus the amount that you are selling that asset should be greater than the sum of both these should be greater than present value which you are paying for. Then it makes sense as an investment to buy it.
Can you?
So basically, I told you that every asset, if you are buying it, it makes sense that in future, whatever the value it is creating, the present value of that should be more than what you are paying. Then only it makes sense as an investment.
Can you give me example and like explain on
This is an example. It's like the calculation you are asking.
Yeah.
You have got it. Like
That's like better understood. Okay. If I have to
Okay.
evaluate something, let's say there is a land which is costing me like 50 lakhs rupees. So how do I evaluate whether it's a good investment or not?
that land I will come later.
So you are talking about real estate. Okay, let's say real estate.
No, the purpose of it is not is to make you buy real estate or nothing. How we can value things.
In the beginning,
So I hope you got a clear idea. So while paying an asset, the amount which we can pay is equivalent to the present value of the future money that we are going to acquire. So when we are talking about like various so again, the thing is, why don't assets trade at their fundamental value? So even if if you take a community of people who are entirely well informed of the fundamental value of the asset, still the assets won't trade at their fundamental value. So for this, I'll show you an experiment conducted on an asset.
You want to connect the project or?
Yeah. Is that right side?
Okay, so the experiment was conducted by Vernon Smith, some Nobel Prize in experimental economics. So here we are creating an asset. It's a 15 period asset. Like consider the lifetime as 15 periods. The asset pays you as a period 15 months. Like anything you can consider. Like if you are treating a real estate asset, every month you get paid. So there is a virtual asset which pays you 15. Like it conducts on a group of educated people, like who are taught about the fundamentals of asset value. So this asset pays me a dividend rate either 0, 8, 28 or 60 at equal probabilities. Okay, it pays me either at each period, it pays me either 0 rupees, 8 rupees, 28 rupees or 60 rupees. Okay, so which equal certainty. So the expected return at each period for me is 1 by 4 into like 0 plus 8 plus 28 plus 60. Okay? Is it?
Just one question.
Yeah, wait a minute.
Actually, you know what? Continue.
Yeah, please.
No, it's okay.
So this will be 24. So at each period, the expected dividend for me is 24 rupees. Okay? Or like whatever. So since it's a 15 period asset and it's being traded at a 15 period asset, and if you assume that it's being done, the experiment is conducted in a short period of time, we are not considering any discount. Like it's a real time. So the fundamental value of asset from our calculation of the value that the asset can generate is 15 into 24. So after 15 periods, the asset dies off. It doesn't have any value. So basically, the people who are told about all this, and this experiment was conducted. So
Can you do one thing? Can you, when you write, whatever you're writing, can you write it in the right part of the screen? Yeah, that's okay. Now it's okay. From now on.
So they were allowed to sit in a room, each being informed about this asset, the amount it pays, and they were rewarded actually with real money. It's not like a virtual, they are paid with real. The amount they acquire in this is paid in terms of real money. So it's a behavioral finance experiment, behavioral economics. So with a simple calculation, we can get that the fundamental value at the beginning, like in the beginning, is 360, isn't it? Like that's the total value that it can generate for us. After 15 periods, it's of no use.
Assuming no discount.
Assuming no discount.
No discount because they are conducted in a small
time.
Small time. So there is no discount. So this is the value that this asset can generate from. So initially, they have some cash. They are given some virtual cash and virtual shares, and depending on whatever they win in the trading, they will pay it in real money. So
What is double option?
So this is a general interface for them. This is the buy quantity, sell quantity. They are given like.
Can we move a little quickly because we have one more talk and
Yeah,
we want to
sure.
finish by 6.
Sure. So at the end of period 1, the fundamental beginning of period 1, the fundamental value is 360. So at period 2, since only 14 periods are left, like the expected value decreases by 24, isn't it? Everyone is clear, right?
Yeah.
So as you go on, this will be the fundamental value for the 15 periods. You can see. So this is done with inexperienced traders, but they are informed, well informed. So initially, people like don't have any interest about buying or selling this asset. Like nobody cares about it. So initially, the trading happens at a value much below the fundamental value. If the fundamental value is 360, people pay around 60, 75. They paid around this one. So the trading happened at that point. So slowly the people move on like very close, very near. So people like you can see that people are not caring about the fundamental value. If at all they had hold the assets with themselves, it could have generated them more value than selling it off, right? But like people have like clear knowledge, they are like interested in the trading.
What is 7 and 9?
Number of volume traded, it's not related. So slowly people start to think that there is some value in it. I need to buy it. People try to pay more price for it, and like it happens. So slowly we can see that it reaches the fundamental value. So people know that this is the value that it can generate for me, but since they are buying and selling it, like people don't care about what usually the value. Like people don't care about the fundamentals. They are worried about the money that it can generate for them by trading. So then, since the person, like people are seeing that the person who is selling it or buying it at a better price, the value of asset is increasing. So they try to buy more and more. So it doesn't stop at that point. It even doesn't stop at that point. You know that at this point the fundamental value of it is only this. It's paying regular dividends. So as you move on, like people start realizing that it's just like it doesn't have any value. Owning it doesn't make any sense. So people start selling it. So as you go at the end, like people will be like, I had to get out of this somehow. Like they just sell it. So this is the point of the bubble formation, which usually happens, like, where the deviation is most from the fundamental value. So this is the general. This is even our mentality. Like we are like not specifically us, but when people go for buying an asset, initially they don't pay any attention to the land value. Suddenly someone buys, increases, and the land value like, explodes. And then again, after some time, it corrects to the fundamental. So when the same people are conducted, when the same experiment is conducted on the same people a second time, people, like the pink line shows you that people still like are better than the like compared to the previous stage. They are little closer in the beginning to the fundamental value and like little closer in the at the end also. So even in the second time, people knowing that this is the value that I can generate from it, people still deviated a lot. But in the third time, people try to like basically it's not that people are looking for the fundamental value of it. people are looking that, oh, if I can buy it earlier even at a better price, I can sell it at this point somehow. So at the end, ultimately, the result of the experiment is when they got some experience, the asset is trading at close to its fundamental value. So in a market in which everyone is experienced about the market fluctuations, assets usually trade at the fundamental value. But markets are always irrational because so many people don't look at the fundamental value and they take. So in a general market, this is the curve it follows. If experience, this is the curve. But the best strategy is always trying to buy below the fundamental value and selling it above the fundamental value.
So the green curve is good for the trader, but not good for the market.
It is good for the trader if he has bought at this price,
And he's going selling at the.
but that's not the case. He could have sold at this price and bought, like someone else would have bought at this price. But nobody can predict like where it
It is
will
going to
go.
go.
So the best strategy, you heard of Warren Buffett. There is something called value investing. So the best strategy for everyone is finding the fundamental value, buying it when it's below the fundamental value, and selling it. So whoever has done that would certainly have made profits. Buying it below the fundamental value, he had more of the assets, so he should have got more of the dividends. So when he's selling at fundamental value, he is above fundamental value, he would have always got a better return.
So a trader should look at when the market tips those cross points.
Yeah,
After that, he's okay to sell.
that's a better strategy. The other strategies could be better, but they are not always guaranteed. So we don't know, like people, it's all on the depends on the perception. Like if I got some acquired here, but I'm not able to sell it here, but still I can hold it because it creates me a better through dividend. It gives me a better value. So for the first time, this is the deviation from fundamental value. If you are like slightly experienced, this is, and when you are like twice experienced, the deviation is very less compared. So this deviation, whichever we are looking at, when the lifetime of an asset is like very large, like when the asset is very illiquid, when you are buying a,
Can someone turn on the lights?
when you are buying a house, suppose, so you don't plan to sell it for 10-15 years. So usually the lifetime of this, whichever curve is forming, is usually large in terms of this thing. But where it gets interesting is when we are talking about stock markets. Stock markets are very liquid. Like people sell them in span of minutes. So even so it's a better example for us to follow the value investing which Warren Buffett, which gave him like all the so we seen that like we have talked about real assets. Now we'll talk about the financial, which is the one of prominent of them is stocks. So what is a share? If there are like what is a stock or share?
So equity.
So what is equity basically? So
It's a
there is some company, suppose TCS. So TCS is a company which is divided in the form of like suppose 1 lakh shares. So if you have the entire 1 lakh shares, that means you own TCS basically. You own TCS entirely. If you own like 50,000 shares, you own half of TCS. So if you own like 1 share, you own like 1 by 1 lakh of a TCS. So basically equity is part ownership of a company. Okay? So similar to how we calculated the fundamental value of the real assets, we can also calculate the fundamental value of the financial assets like stocks, bonds, other things. So if you take a company, the fundamental value of the company can be like arrived at various ways. But always like converge at the same place, I told you. It's the value that the company creates in the future. So if TCS is making like certain amount of profits, and the profits are maybe increasing in future or maybe decreasing in future, the present, how much time do we have?
Just can you wrap it up in like 5 minutes?
Okay, then it can't be wrapped up in that. So,
Please,
Yeah.
allow this talk, please. I don't know what this is like. Seriously, okay.
So you want him to continue for
You're
longer?
next speaker.
You,
Yeah?
how much time do you have?
I don't know. I can go on like it. I don't know.
How much time does everyone have?
Can I
Is it
speak
okay
next?
if this goes past 16?
Yeah, it's fine for me.
Can I
Is
speak
everyone
next?
okay?
Because I have like a lot of shit.
Oh, you have a lot of stuff.
Like I have stuff, you know.
Okay, cool. Can you wrap it up in 5 minutes?
But that is so interesting.
so
Hey, Chandra, or can we do it like
Yeah.
next Friday? Because this is.
We can do a part 2
Yeah.
for this.
So we concluded the beginning of
Yeah.
what is an equity.
Yeah.
So equity is part ownership in a company.
Okay.
So if you are the best strategy, obviously for buying an equity is buying below its fundamental. But arriving at fundamental value is the
Is the next
next challenge of
What calculating the fundamental value?
fundamental value of equity. Shares.
Shares. That is
So-
something.
All right.
It was interesting.
Good talk.